Hi, everyone. I'm Ganesh. I'm one of the founders of Covalent. I excited to be here with Erik, who leads ecosystem growth at Covalent, and Tommy, who is the founder of APY Vision, which is an analytics tool for liquidity pools. But I'm sure I'm botching that up. I'll let him give an intro later in this call. But the purpose of this call is to share what we've learned with the Sushi Onsen program that we kickstarted a couple of weeks ago. I would say it's been going pretty well, but there's always room for improvement. And really what this is to share the progress that we've had there, some of the specific choices that we've made with regards to the liquidity pool, and then a master session by Tommy, where he's going to be talking about the pros and cons, the risk factors, and what these the participants need to be aware of, so that you can be more diligent in your participation. So that's really what the rough outline is. We will have a Q&A at the end for questions from the audience. But yeah, let me take it away. So the first question is, let's talk about staking itself, right? So there's two kinds of staking programs that we are launching at Covalent. The first, which is live now, is the Sushi Onsen staking, which is known as the double-sided staking program. What that means is that you need to invest, or you need to deposit both sides of the asset in order to participate. So that in this particular case, the pool that is being incentivized is the USDC and the CQT pool. So you need to invest the CQT and USDC in the right proportion, and that's how you participate in the pool. The second kind of staking program, which will launch later this year, is a single-sided staking. So if you see acronyms like S3, that's what it means, which means it's a single asset. All you have to do is go and deposit your CQT into the network. That's a proof of stake network. And then you will get a yield there. And the estimate there is anywhere from 10 to 20%. It's yet to be determined, but that's coming later this year. That's not live yet. The purpose of this call is to talk about the Sushi Onsen double-sided incentivized staking program. So that's just to clarify and set the stage on what the specific programs that we have. So let's start with the first question: why Sushi Onsen program? From our research, there's a lot of incentivized pools out there. There's definitely, Uniswap. You can run our own incentive programs. These are just liquidity mining programs just to incentivize DEX liquidity. But from our research, what we found is that Sushi has the best marketing programs. So if you were here for one of our AMAs last week, we had close to 500 people who showed up for that audio AMA on the Sushi Discord channel. So their marketing support is spectacular. Outside of that, we really like what the Sushi program, what the Sushi team has been up to, like especially, with deploying on multiple chains, the multiple products. Yes, it did start out as a simple fork of Uniswap with a token, but today they have a lending product. They have a really exciting NFT product. So there's a lot going on in that ecosystem. So really love that, how they're pushing the edge of what's possible in terms of innovation. So, we feel very compelled to participate with their team. So I think that's what it comes down to. Now, if you look at some of the other farms on other kinds of chains, from the tin, from the label on the tin, it appears like those guys give you triple-digit APRs, really high returns. But there's always a risk, right? There's always a risk. So we'll get into some of those other aspects on future liquidity mining programs that we have in place. So bottom line is, Sushi is a well-regarded, respectful liquidity, like a program where we were comfortable participating in it, and we're not putting our token holders at too much of a risk. And then the marketing support was also a bonus. So that's why the Sushi Onsen program. So generally in Sushi, what you can do is you can go invest or deposit your two sides of the assets, the CQT and USDC in this case, and you would get liquidity, the fees, just the fees from transactions. So what exactly the 2x means is that on top of that, you're also getting extra Sushi rewards and extra CQT. So that's what the 2x program means. So not only are you getting the liquidity fees, you're also getting these other rewards. So that's what it means as an incentive pool. And last I checked, the liquidity there was hovering around $1 million. and the APYs were anywhere from 40 to 100%. Of course, this is always fluctuating block by block, depending on what the rates are. So, but the thing is, we can change those rates every 2 weeks. So if we find that we need more liquidity on the DEX, we can always change the rate, and then the APYs will go up, and then more liquidity will flow in, and then the APYs will drop. So that's really what is under our control. So the progress we've had so far. Now, when we launched this program, we had a KPI internally, like, let's hit $1 million. And it seemed like $1 million of liquidity. That's like one side. So it's actually $2 million of liquidity because it's USDC and CQT. But we were just looking at the USDC side. $1 million of USDC, let's hit that as a KPI for this quarter. And it was one of Erik's goals. And it was crazy to see that we hit that goal in 2 days. And we were surprised at the response. So it shows like how excited people are about this. Of course, the marketing support is also spectacular. But what has happened since then is that the token price has had a dramatic rise in price. So it's gone from something like 30 cents, and the all-time high hit I think 2.1 over the weekend, and that has led to a lot of confusion with regards to employment loss, and in regards to what exactly the returns are, what are your actual nominal returns on the, like, what do you report to the tax authorities, for example, right? You need to understand that. So hopefully Tommy can give us some insights with API Vision there. I think that's a lot. It's quite complicated, even things that I don't understand, and this is why we have experts like what are they called? Gigabrains like Tom to share his wisdom with us simple plebs. So excited for the latter half of this call. So that's what's happening. I think it's still hovering at $1 million. You can go to the Sushi website and see what it's like. The third bullet point I'd like to discuss is upcoming plans with with cross-chain liquidity mining. Now, there are pools on Polygon, on Avalanche, on BSC, which seem pretty exciting. But I think the precursor to having any kind of incentive pool on those chains is getting your asset bridged across to that chain. And right now, I'm just going to be honest, I'm not comfortable with any of the bridges that are out there. The bridges have a variety of risks, all the way from custodial risk to non-custodial risk. So, you have like custody of the assets, and I would never want to put our token holders at risk. This is why CQT is not available on BSC or Matic or Avalanche or any of the, those ecosystems are excellent. We partner with all of those chains, we index all of those chains, but CQT, the token itself, is not available on those chains because the bridge technology, I don't think it's very mature. So I think we'll just take, we just have to wait. We have to see what's going on. But once, there's a bridge technology is mature, so it's, crossed our internal risk controls, CQT will be available on those other chains, and then we'll just participate in the mining programs. We might actually just go with Sushi because Sushi is our partner, and we might just participate in the LM program on BSC or Polygon with Sushi and CQT on those chains. So that's the blocker there. This is why we get a lot of questions. Why am I not able to use Pancake Swap to swap CQT? Because the gas fees are a fraction, right? They're dirt cheap compared to Ethereum. Ethereum, I heard some people spend hundreds of dollars just to participate in the program, and on Polygon or on BSC, it's a fraction. It's a couple of cents, so it's a no-brainer. It's just that the bridging technology is not something that is super solid today. So yeah, that's basically the high-level summary of what's going on with the Sushi program. What we have now. I'll hand it off to Erik, and then after Erik has his thoughts, we'll hand it off to Tommy to walk us through API Vision, how to study your position, how to understand your returns. And this is not specific to Covalent. It's like liquidity mining, but there's a lot going on in API Vision. So I've known Tommy for a couple of years now, so very proud of what he's built with API Vision. So it'll be like a product demo there. But on to you, Erik.
Yeah, thank you, Ganesh. So I guess some people have reached out to us, or to me more specifically, maybe, and they've asked a few questions about staking and how this is going to work at scale. And the reason why I think it's interesting is because, unlike the Covalent is not a blockchain, Unlike some of the other projects, you know, if you have Avalanche, it's more to validate transactions. If you're on, you know, Polkadot, there's a block accrual mechanism, Moonbeam, et cetera, some of these other chains. So yes, Covalent is an EVM, but to give a little bit more light about how this actually works and what we are doing, because some people have asked, you know, are we going to launch our own blockchain, or is it just a token? And I guess how this works at scale, I'll just run through this quickly as a quick reminder if you're not familiar, is what Covalent does is we're obviously selling the data at scale. It's going to be a USD based database, which there will be a market buy from USDC as an example to CQT, which will be paid out to validators on the back end after they've fulfilled data queries. So right now, as an example, you know, lots of applications are building on Covalent. So let's say APY Vision is querying data. They would leave some USDC in a smart contract. There'd be a market buy, and then the validators would be paid out after they've fulfilled the data. And for this reason, this is why we've spent the time to go and get professional, I say grown up, but big boy validators who are used to doing this stuff at scale, because we're taking this very seriously. And those are going to be the first people to start I don't want to say beta testing, we're going to start running our first set of infrastructure. So as we move out to a single-sided staking in the next couple of months, which is going to be, I'm very excited about. You're going to see these people start running their own type of custom infrastructure. The token lives on Ethereum, but you know what we've done with Covalent, it's a private IPFS, so it's not its own blockchain. It's just meant to ingest all of this data. You're not going to be able to deploy smart contracts and do stuff like that on Covalent. It's just we're building out this decentralized infrastructure. So. Yes, the token is unlike other blockchains. Like I said, just to reiterate that there is a value accrual mechanism, but it's not just burned by like staking and minting rewards. So there's a lot more to come there, and we're really just scratching the surface. So yeah, very, very, very excited about that. With that being said, now that I think that answers some of the questions, I'll pass it over to Tom.
Thanks, Erik. Hi, everyone. My name is Tom, and I'm the core dev of APY Vision. And I'm going to share my screen here with everyone. So can everyone see this? A little thumbs up. Yeah, okay, great. So yeah, today's talk really is kind of an overview of what liquidity providing is and what yield farming is and how the relationship of the two kind of plays in. And along the way, I'm going to also give some feedback and also some ideas about what you should be looking out for if you were to go into yield farming and liquidity providing. But I thought I'd start off with an introduction as to what the traditional exchange and traditional setup was like before we had decentralized exchanges. Previously, exchanges and market makers, they would supply you with the trading pairs, right? So if you go on Binance, for example, you can do the any pair you want that they support, and you can buy it. But the problem is they make the fees that that you make on the exchange, and every single time the fees is being collected by the exchange, and so the exchange business is actually one of the most lucrative businesses because they're able to collect all these fees. I think BitMEX, they were saying that like they collected like a bunch of fees because people were essentially playing with leverage, and so the fees compound that way. So that's the traditional setup. And what's really cool is that with DeFi and smart contracts, we're able to actually make this into a marketplace, essentially. So you have people on one side who are still the traders, who are still swapping and still trading, but it's all governed with smart contracts, where now anyone can become a liquidity provider and send in their tokens to the smart contract and share the proportion of the trading fees that is collected. And what's really cool is that it's all permissionless and it's all trackable on the blockchain. So for example, Binance has a program where you can actually stake on Binance itself, but the problem is you can't access their data. So they could be saying that, oh, the volume is $1 million, but in reality, it could be 100, it could be $1 billion. You wouldn't know because it's a centralized service and you don't have access to their database. But with blockchain, it's all transparent, and so everyone can verify that. And as a matter of fact, we at APY Vision, we index a bunch of the AMM data so that we can verify and we can collect that information. So what's really cool is that we feel that this is a revolutionary idea, and it actually enabled a new breed of investors. The people on the right, where people have extra tokens to provide liquidity for, and then they earn a fee by providing it on the exchange. And there's now more and more AMMs on the market. We started out with Uniswap, and Ganesh is mentioning Sushiswap is now someone a partner that is doing a lot of volume. We also have Curve, and then QuickSwap as well, if you're on Matic. So there's a lot of exchanges that are up and coming. And what's really cool is that if you look at the DeFi ecosystem, currently it sits about at $140 billion. 30 to 40% of that is actually locked up in AMMs by liquidity providers. So that's actually a very big space for liquidity providers. And the reason for that is obviously they collect the trading fees, but they also can participate in liquidity mining programs, such as the Onsen Program and with CQT. So yeah, liquidity providing will continue to play a big role in DeFi. And what's really driving it a lot of the times is not just the trading fees collected, but also this concept of yield farming. And the idea is that protocols are often rewarding users to essentially lock up their tokens and also provide liquidity in exchange for the rewards in their native protocol. And with the Onsen Menu, they also get the Sushi rewards as well. So there's basically multiple rewards in that program, but the idea is the same, which is that the users are rewarded based on whether or not they're providing liquidity for the protocol. This was a playbook by some of the early DeFi projects, such as Synthetics and Sushi as well. So what's really cool is that there's the idea of project growth, and the idea is that if the project doesn't grow, then the token doesn't go anywhere. So the project rather give away the tokens and have the project grow, rather than not have any growth. So that's kind of the genesis of yield farming, which is to incentivize people to use the platform, but then also incentivize people providing liquidity to the token so that it's more liquid and it's more tradable. And like I said, Sushi is now a big partner. And just a little FYI, they actually created the Master Chef contract, which is a very popular staking contract that is actually still being used today. Part of the Onsen Menu still uses the Master Chef contract. So that's a pretty I would say common yield farming contract that a lot of other projects are also using. So I want to talk about APY Vision a little bit and our mission. A lot of people don't know this, but there's actually over 6,000 farms in DeFi out there and growing by the day. And it's very hard for people to track them all and to make sense of what their gains are, because there's a lot of unknowns when you're calculating profit and losses. And so our mission here is to help liquidity providers across DeFi to make confident decisions about their investments. And we want to maximize the returns. And what we want to do is we want to build an analytics tool that caters specifically to DeFi users and also liquidity providers. And yeah, so this is a little bit of our product in action. So one can see once they plug in their user address, all the pools that they are currently in. And because of this concept of impermanent loss, when the price ratio of when you enter the pool changes, you will get what we call impermanent loss. And so that means that you will get more of one side of the token and then less of the other side. And depending on the price ratio changes, that could adversely affect your profits. And so we try to make sense of it in a visual way to help you understand that. And so we introduce the concept of where we have the opening tokens that you own and the current tokens you own based on the market movements. And then we try to make sense of it by calculating the profit and loss in US dollar value. So in this case, this pool actually is currently lost money because of the fluctuation in the tokens and also the price. So we show you that. We also show you the farming rewards that you've been getting since you are in the pool. So that gets added to the profits that you're making. And then finally, we add all this up together. This other pool that this user is in, they're participating in dual rewards. So they're both getting the Sushi as well as the Matic in this case. And we show all of that information and we make sense of it. So yeah, we try to track the profit and loss and yield farming, not just for one AMM, but across all the different chains that we support. Currently, we support about 13 different AMMs, and we're on 4 different chains. That's going to continue to grow as we, as there are other chains and other AMMs. We also show a little bit more information, not just your current position, but also some hypothetical situations, and also information about when you entered and when you exited. All of that stuff is bundled into our suite of tools. Just one note on that is that our tool will always be free. So it's free to use. You can pull up your position, you can pull up your accounts. But if you do want to be a professional member, then we also offer a more sophisticated service as well. So, but yeah, the base tool will always be free. And then also we have a research section where people can find investment opportunities as to the historical performance, as well as trying to look at the historical volumes, because that's one of the determining factors when you are looking at a pool, to make sure that not only do you get good trading fees, but you also could get some yield opportunities from yield farming. So we're actively working on providing our users with the best analytics for their research opportunities. And then also within the pool, you can look at various factors, growth of the transactions, the price growth, the average swap size. And here we use Covalent for our pricing, the historical pricing, which helps with all the calculations. Yeah, so if you guys are interested, please check out our website. It's apy.vision. We just recently launched a version 2, which has all of the chains together in one, and also the different AMMs together in one. So we're pretty excited about that release, and we'll be continuing to add on to the tools.
Amazing. Thanks, Tommy. Pretty sophisticated tool if you're serious about liquidity farming, and not just like CQT farming, right? I think this is like it's a no-brainer to start using the tool and then upgrade if you see value in it. But I have some questions from the audience, which I would love to get your input on. So one question here is, if the market is not steady, there will always be a loss. I tried double-sided staking on Sushi, and I lost 40% of my CQTs due to the price difference. Considering CQT is still in an uptrend, why would I choose to farm if I am going to lose CQTs while I'm expecting to earn more CQT? So let me set the stage here. So the price has dramatically run up, and essentially at this point, this person is trying to understand if they held on to that CQT without the loss due to impermanent loss, it will the dollar figure of CQT with the rise. I think it's gone from 30 cents to $2. Would it have become a better outcome, or is there a middle ground? So that's really, so is there a calculator where investing in a pool versus just sitting on my ass and doing nothing, right? So I don't know what you call it. Maybe it's literally called sitting on my ass. I don't know, but is there something like that? So I would love to get some insight on this person's question.
Yeah, definitely. That is a risk because, remember, when you enter the pool, you need 50-50 of USDC and CQT, right? So if you had sold your CQT initially for USDC, you already had basically exited half the position, right? In which case, when CQT went up, you're even worse off. So yeah, definitely bull markets when the price keeps going up, it's actually not a great idea to provide liquidity, because not only do you have to get 50% on the other side, which most of the time is a stable coin, you also are subject to impermanent loss, which is any time that there is a price ratio difference from when you entered the pool to what it is now, you will suffer some amount of impermanent loss. And so our tool actually helps you with visualizing that. And a lot of our users find it helpful because, when things go up 20, 30, 40, 50%, that's when they know to exit the pool to prevent any further deterioration of losing their CQT in this case. So we also have some visualization tools on our site where we give you hypothetical situations for situations like that. So I can share my screen real quick again. Everyone can hopefully see this. So I'm in this pool where if I had not gone in this pool, it will tell me the what I would have made. So in this case, if I had kept all my capital in ETH, I would have made probably 50% more, right? Because as some of you may know, ETH is up relatively a lot against BTC in the last 6 months. So I actually would have made more money if I had not gotten into the pool and I just kept all my ETH. So we show a lot of that information and also hypothetical situations as well. Hope that answers your question.
Yeah, no, it's great. So it works on the other side too. If there's a dramatic drop in the price, you're also going to lose your primary asset. It works on the other way down too, or are you DC your dollar cost averaging in? Like, is it a bonus on the other side?
Exactly. So a lot of our users find it helpful to be in pools because obviously in the bull market, that's great, but you don't know if it's a bull market coming. Sometimes it's a bear market, sometimes it's a sideways market. So in order for you to quote unquote hedge your bets, a lot of people go into the pool And if CQT goes up, that means that they get less CQT but more USDC. And then the other way, if CQT goes down, which we don't want that to happen, obviously, but if it goes down, the user ends up getting more CQT, and then they get less USDC than they started with. So it's kind of like a balance in that act, and it depends on your comfort level. Some people, like this strategy because they're not day trading. They just kind of set it and forget it, and they don't really, have to actively manage it, which can take a lot of effort to do. So people find this helpful, and along the way they're collecting fees and they're also collecting rewards.
Okay, from our side, if we want to make sure people are whole, right? Going back retroactively, what would be the calculation? Would it be the loss due to impermanent loss minus the rewards that we give out to the double staking, the dollar figure, minus the fees, and then that would be the loss? Is that how you calculate it? Does your tool do that?
Yeah, exactly. So we denominate everything in US dollars. Other currency support is coming, but essentially a lot of these farms are saying, it's 1,000% or 1,200%, but you have to remember a lot of these tokens that they get are coming from their own protocol token. And so even though you're getting quote unquote 1,200%, if that token has gone down 80% during the time you've entered until when you exit it, that's not a good deal for you in absolute US dollars. So we track that via US dollars, so that, yeah, it makes sense from a profit and loss perspective.
Okay. If you were to go back and revisit this, would it have been a better choice to pick ETH as the base pair rather than a stablecoin?
A lot of projects do use ETH precisely because ETH does go up, and alongside the other token. So it's more or less in the same direction. With the stablecoin, it's it's relatively stable. So if the other side, the CQT side, takes off, then there will be impermanent losses due to
Okay.
price ratio changes. Yeah.
Awesome. What about stablecoin? So let's say I'm sitting on X dollars of USDC. I don't need it for 6 months to a year. What is the right kind of farming? And I need I'm not willing to take risk. I don't really care. I just care about first 0%, which is just sitting in my wallet, or whatever 0.2 that your traditional banks give you. So anything 5% is also good, 10% will be great, but I don't really care about 50% or 100%, right? Because that's too much risk. So what would you recommend is a good pool to get your stablecoin returns on?
Yeah, definitely. So I highlighted a few different AMMs, and they have different characteristics. So for example, Curve, they focus mainly on stable swaps, we call it. So where the two tokens are relatively stable to each other. And so you don't really get that much of an impermanent loss. And the trading fees on that, yeah, you can look at anywhere from, 2 to 12 to 18% on your stablecoin deposits. So that's quite popular exchange that people essentially stake their stablecoins on.
And there's no impermanent loss there because the two sides are, the ratio is constant.
That's right. So yeah, the price ratio doesn't fluctuate too much from when you enter to when you exit. So people love that because they won't have any impermanent loss due to that, or very little at least.
Got it. So there was a question here about gas fees. I did answer this question earlier in the call, but let me repeat it. So gas fees are brutal on Ethereum. I've heard of stories where people spent $200 to enter the pool. So that needs to factor into your P&L as well. So it's quite challenging. And it would be a lot simpler and a lot cheaper to have CQT and the pools on BSC or Polygon or Avalanche. These are excellent tools. So what I did mention early on today is that the bridge technology is not 100% robust. At least that's my opinion. So if you were to bridge CQT onto one of these other chains, there's a lot of risk with that bridge. And if that bridge were to get hacked or something were to happen, all of the liquidity providers would just lose the assets. And then I don't know what's going to happen on the other side either. The asset will get disconnected, would the peg fall? I don't know. So I think we're just going to wait and see. And generally, I think it's a better idea to focus on one pool, incentivize that one pool rather than fragment your liquidity across multiple pools. So once CQT reaches a next step of growth, then we would definitely investigate Polygon and BSC and Avalanche and Phantom. There are lots of pools on lots of blockchains for cheaper gas prices. Okay, so there's one question here. This is a mathematical question. So can we have an example of entering CQT USDC pool with 100 tokens at 2 USDC and 200 USDC? What will be the result if CQT goes to 4 USDC? What will be the result if it goes to 1 USDC? So just a follow-on question here. Does APY Vision have a scenario planning calculator, like exactly where you can plug in these numbers, like not just your current positions, but what if you had X and you just play out the numbers? Does it have such a tool?
Yeah, so we don't have a simulator, but what we do have is a historical impermanent loss chart where people can see what has impermanent loss been like, and also looking at it visually so that people can make a sound decision as to whether or not to get into the pool. So that's in our pool research tool or section in the tool where people can understand that information.
So this example here,
feature there. Saying, Tom, that's a premium feature. There you go. I would pay for that.
Yeah, I can actually share my screen really quickly just to share how that looks like. So for example, I just pulled up a random pool here, but you can see the price changes. And thanks again to Covalent for providing the historical data. But you can see that the price change relative to what it is now and how that affects the impermanent loss over the course of a year if we were to extrapolate that into an APY. So for example, if you enter the pool 60 days ago, you'll see that that impermanent loss for the period was 15%. And if you extrapolate that throughout the year, it's 93%. And so the fees you collect over the course of that year is only 36%. So you actually could theoretically be down if that trend continues. So this is information that a lot of our users are using to determine, when the best time to get in and also when the best time to get out. So
amazing. So I think sense? Oh yeah, no, this is a beautiful chart. I love this. This is just like, it's a very clear picture. Actually, what I'm thinking is that you should have an API or an embeddable widget that other projects can embed onto their sites, so that they, you get more distribution on this data. This is very valuable data.
Yeah, that's a great suggestion.
Cool. One final question. This is not related to this particular session, but it's a very interesting question. I believe I have seen this question through our support channels, and I did answer them, but let me repeat this question. So Erik did mention that the way the network actually works is that users pay using stablecoin USDC, USDT, and there's a market buy mechanism on the smart contract to buy CQT, and then the CQT is distributed to the work performed by the validators on the back end. This could be the storage nodes, this could be the indexing nodes, this could be the query nodes, the block specimen producer. So those are the various roles. These roles are described in our white paper. Also, we're having a couple of events later this month to really teach the audience. So the question here is, has a market buy ever been conducted? What would the percentage of income be used to buy CQT? When will such a market buy data be disclosed? For the security bot using such funds, what will be the disposal plan, burn or redistribute? If redistribute, who will be the recipients? So let's start with each question here. Has a market buy ever been conducted? The answer is no, because we are starting with the decentralized network on the bottom half of the data pipeline, which is the indexing portion. So for the next year and a bit, the API is going to be completely free, right? So people can use the data, consume as much data as you want. So people are not paying for the API right now. So such a market buy hasn't been done so far. And the contracts are also not live. So the answer to that question is no. What would be the percentage of income used to be to buy CQD? I would say the fair percentage here is 100%. 100% of the fees needs to go to the people providing the service. So that would be a fair portion. Maybe in the future, we could do something like Pancake Swap, where there's a developer fund and a percentage of that goes to fund the team building it. But right now, we have enough runway, so that's not an immediate concern for us. The other question is, when will such market data to be disclosed? There's no reason to disclose this because everything is on chain. You can literally use Covalent to pull out the per transaction granular fee structure. So really that simple. I mean, that's the whole point of Covalent. So there's nothing for us to do. Everything is on the blockchain. From the security bot using such funds, what will be the disposal plan, burn or redistribute? So the CQT is used to distribute it to the people doing the work, right? So we could, in theory, burn a percentage of that and make it a deflationary token if you wanted to, but that opens up very complex legal hurdles with CQT being classified as a security. So we definitely have to get legal counsel on adding all of the burn mechanisms to the token itself. But right now, the plan is to distribute 100% of that CQT that is bought to the people doing the work in different proportions, because different, like the indexing nodes and the query nodes and the storage nodes, they all participate, and it all of it has to flow downstream. So there's like some rebalancing then. If you were to redistribute the recipients, the people doing the work. So it'll be all of the validators, all the storage nodes, all the query nodes. So hopefully that answers your question. Cool.
So,
okay. So
I'm going to ask. There's one thing so I know Jordan, Mr. Jordan Smith, who's actually messaging me right now, who wants this question answered. So, can you help me draw a parallel to traditional lending? If I'm a U.S. investor lending to a Japanese client, I'm selling USD to buy JPY, earning a JPY return. So there are two sources of return: JPY/USD price ratio change plus interest yield farming, with a question mark. So to give you an example, Jordan, to play that back to what we're doing here is, think of in this situation, you have your CQT and you have your USD. They're two separate assets, sort of like JPY and USD. You're putting them somewhere. You are earning some reward interest every time somebody is swapping from USD to JPY. So you're earning a little bit of that liquidity in the as a yield just for leaving your assets there. So it's the same thing as lending the bank interest. The interest is just paid much more frequently, and probably in some cases more as often as the trading actually happens, opposed to a set annual rate. And then in this instance, you are earning, you're not just earning the trade fees, but you are earning additional rewards. So imagine just by lending it there, you get paid on the transactions, but then you get an additional reward. In this situation, if CQT is JPY, you're getting an additional reward in JPY. But then because of the nature of the double yield Onsen program, it's like the equivalent of getting paid in additional euros for some reason, just for being there. So you're staking two types of currency, USDC and CQT, getting a little bit of the CQT, and you're getting an additional Sushi reward. So there's three types of currency in play. But yeah, it's obviously much better to get paid into speculative assets than no speculative assets. So just to answer that question.
Great. One final question, very interesting question, and then we'll close it off here, because I think the questions will keep coming. It's a very interesting topic. So, good morning, Kings. I love the opening here. My question: if clients aren't paying for the API, how are you generating revenue, and will the protocol?
Ganesh, you're muted. Ganesh, you're still muted. There you go.
Am I muted now?
No, you're good.
Okay. So good morning, Kings. I love the opening line there. Hope you are well. I should actually say GM on Twitter every morning. Why not? My question is, clients aren't paying for the API. How are you generating revenue, and will the protocol eventually generate revenue? Thank you. So the question is that we are not charging for the API. So the protocol is not generating revenue from the demand side, the people using and consuming the API. We are generating revenue from the supply side, which is the blockchains are paying us to compensate us for the product, for our time, for our effort, for our support. So you go to Discord, we provide support for all of these API for these blockchains. So they pay us as a service fee, not as protocol fees. And my theory here is that we're very, very, very early in this market to start charging for the product. And we are in this growth phase right now, where I think the space is going to grow at least 5x in the next 2 years, at least minimum 5x. So we do not want to have any barriers to product adoption, and that includes pricing. That includes we're just tackling all the barriers. So we want to add translation, for example, so our APIs will be available in Chinese and Japanese. And I think it's if you're a long-term thinker, creating revenue on day one is not the best choice. Like, go out there, let people use the API, because the secret here is that the feedback that we get from devs, like, look at Tommy, like he's been using the API for months now, and he's given us very, very detailed feedback. And you cannot really put a dollar figure on that. And if he had said, hey, Tommy, you got to pay us like a couple $100 to use the API, he's like, you know what? I don't even know if this is going to solve my needs. Forget it, right? I'll look for an alternative option. So give it out for free. And it's really a moat that we have, because we're able to advance the API so much from detailed feedback from the hackathons, for example. The guys that are building these projects, the hackathons, we sponsor like 4 or 5 hackathons every month, right? So we're very active in the hackathon scene. Those guys give us so detailed feedback, and we're able to predict trends before they become mainstream. So we started investing in the NFT space back in October, before the whole NFT craze. Like, we started investing in the DAO space before DAOs became crazy, right? So I think that's you can't really put a dollar figure on that kind of like intel, that kind of alpha in like product dev. So I think it's it's actually premature to start charging the API, but eventually we will be charging the API, because the protocol has to be sustainable. But that timeline is, at least 1.5 to 2 years out. So final question here is PancakeSwap. I actually don't. Let me pen some thoughts on why I don't trust these things. It's just an icky feeling on my side. Maybe I'm not being rational here, but it's definitely, every single decision that we've made on the last, couple of months is due for a revisit 100%, because the space moves so fast and it's maturing really, really fast. So yeah, I think we'll close it there. Unless, Tommy, Erik, you have something else to add?
I think there's one other thing I'd like to add, just to the point about securing the network. I think one of the other things that's very interesting is, and an advantage that we have is that the product we have works, and it works really, really well. And it's kind of interesting how when people see a functional product and they know what's coming, you have a very different outlook on the market, where people are able to sort of come in and have different conversations, who are playing at a very different level, who see the vision, see what's coming, and they're themselves are looking to secure large positions of CQT. So like I said, this is not, it's interesting when you get to the scale where you have 300 plus projects who've launched, and people are seeing, you guys who are all here, who are all showing up, they see the community, they see how active people are, and the conversations get to be very different when you get to the scale that we're getting to, and when the market is going as fast as it is. So this is not us saying we're doing a great job. This is us. This is me saying you guys have done a great job at supporting us and showing up to these things and using the product and asking like really tough and very, very thoughtful questions. So yeah, it's a lot of the reasons that these large conversations, it's the really exciting ones are happening now. It's all you guys. We build the product, but we're nothing without the people who show up to these things. So I just wanted to say thank you to everybody attending.
Amazing. Okay, so now for the final thing, Prateek, let me know how do we get that magic POAPs?
Yeah, so POAPs will be sent out to everyone who's registered, who has attended this call, and will be sent out via email. Just to make it fair to everyone, the bots are getting hijacked for some reason, so we are only sending it via email. So thanks a lot, guys.
Awesome. Okay. Thanks, everyone. Almost 200 people showed up to this call, which is pretty amazing. Thank you, Tommy, for your being very gracious with your time. Very, very generous of you to walk through those examples. But this is just a start. We'll have more events along the Sushi side in the coming weeks. Until then, see you. Take care. Bye.
All right. Thanks, guys.